Can you stomach a 20% portfolio drop? It's the topic of today's Steady Wealth podcast. Hey, everybody. Serge Berger here, your host of the podcast. Today, sponsored by Blue Marlin Advisors. That is our investment advisory firm. We're going to talk today through the lens of research, as we usually do, looking at the markets. Now, I'm going to keep this one brief here today, but I think it's a very timely and appropriate point in time to look at the markets and discuss market volatility. And when I say discuss market volatility, asking ourselves an honest question. And that question very simply is, can we stomach a 20% portfolio drawdown from how the portfolio is currently allocated? To put this into a little bit of context, I'm going to show you a few charts. I'm going to walk through some current examples. Now, obviously, as always, I assume most of you are going to be either listening to this on one of the podcast platforms like on Apple, Spotify, you name it. For those of you that are watching this on YouTube, you will have the benefit of also seeing the charts. But as I always say, if you're just listening to this, you're not missing out on anything. I will describe the charts just as well to you. So please don't worry, you're not missing out on anything there to be concerned about. If we look at the markets here year to date, I'm just going to look at a few things here and walk you through for perspective. Equity markets, particularly U.S. equity markets, which is really what we're referencing here today, are up sharply. The bond market is not doing too hot, at least not yet. We'll see what the remainder of the year brings. I suspect we're going to see some better days in the bond market before too long. Be that as it may, what we are certainly seeing is more investor complacency once again. And that, of course, makes sense. I am always on the record here talking about how it's very difficult to talk to investors about any sort of rational risk-taking, meaning risk-taking with taking risk into account and not just looking at the reward when things are going well. In other words, again, when you look at the markets now, S&P 500, bonds, actually everything, the typical 60-40 portfolio was down a lot last year in 2022. Of course, we look at 2023, and the equity portion of that is up dramatically. Again, S&P up 20, NASDAQ, I think still north of 40. As I'm recording this, we'll see. Of course, could be a different number when you watch this. But typically, when you see that kind of dynamic in the market where drops are short-lived, people are just simply not spooked. And it becomes really difficult to talk about volatility, which is why exactly I would like to talk about volatility here. I literally just finished off a couple of client calls today over the past couple of hours, and you can tell people are extremely confident. They're, in my view, overly confident. Not that they're bad at investing, but they don't know how they will react when you do have a drawdown, when the portfolio draws down, which is typically basically when the S&P 500 draws down. Now, that certainly applies to American investors here in the United States. Most people are heavily, in my opinion, probably a bit too heavily allocated to U.S. equities. I've mentioned this, I think, in the last podcast or two podcasts ago, that if we look at recent surveys of baby boomers, and we notice that the vast majority of them are in way too much equities relative to the risk they can actually stomach. And that gets us, of course, to the question of risk. So let's define risk very simply. The way I look at risk is volatility. Volatility is risk, and here is why. So typically when we look at markets, it's famously quoted, you tend to have the escalator up and the elevator down. So I'm going to go to the first chart right now. I'm going to quickly share a screen again for those people that are listening this on the podcast, or like the actual audio podcast. You're not going to see this, but again, do not worry. I will, of course, describe this for you. So don't worry. I'm going to quickly see if I can share just the chart. I think that should be possible. Yeah, there you go. So what I'm showing here right now is a chart of Apple. It's very simple. It's stupid simple, but we're looking at right now, this is actually as I'm recording this live. And what you can see on the screen here, and again, I'm describing this for those people that are listening, is you can see that Apple essentially took about a month and a half to go from $180 to where it topped out. I'm going to call it around almost 200, not quite, a couple bucks short. In percentage terms, going from 180 to 200-ish, that's about an 8% move. So Apple took a month and a half to go from 80 to almost 200. A month and a half, that's 8%. However, it took exactly 4 days, right? A month and a half versus 4. So a month and a half is, let's say, 45 days up. Sorry, bad math. 35, a month and a half, let's say 15 plus 30. Yeah, 45 days to go up. It took 4. 1, 2, 3, 4. That's it. 4 days to go right back down to where it was. So number one, the point I'm trying to make is I don't like to chart chase. Everyone knows that. Yes, that sometimes leaves me from missing out on an opportunity. I'd feel much more comfortable buying Apple around where it is right now. For those people that are listening, this is not advice nor a recommendation. I'm just telling you, just from a reward to risk perspective, I prefer to buy it here than when, it was basically going up nonstop without pullbacks. Just all else being equal. And I'm not buying Apple here, by the way, this second. I'm just telling you, just if you think about it, because you have this down gap risk. When things go up with the escalator, they come down with the elevator. That's simply how things go, which is why chart chasers usually over time don't make money. That's also one of the problems with the financial media, particularly the ones where the chart chasers themselves are loudest. So you look at a Twitter and other platforms. I don't want to name names to offend too many people here with those platforms, but typically the people just hold and basically erase all their gains that took them months and years to do, and they erase it in a matter of days, weeks, or maybe a few months. So we don't want to do that. That doesn't make much sense. It's frustrating and doesn't make money. However, the point here is about volatility. It's about risk, how much volatility is one comfortable with. So to show that, what I'd like to do is I'd like to move on to a hypothetical portfolio. And this is a tool that we use with our clients at Blue Marlin Advisors, again today, sponsored by Blue Marlin Advisors. And what I'm going to show you or talk to here right now is the importance of actually understanding how much risk one is actually comfortable with. So what that means is we need to be able to determine how much risk we are comfortable with, because if we don't know how much risk we are comfortable with as an investor, it is really difficult, if not impossible, not to sell at the absolute worst moment. And if there's one thing that I've seen over the past 25 years in this industry, is that most people, and that includes professionals, sell at the absolute worst time. This is well documented. I think everyone's probably heard it. The problem is now we're still apparently in this sort of 12, 13, 14-year raging bull market, and people have forgotten what their actual risk tolerance is. They haven't seen it. They've been desensitized because volatility has been so low. So let me walk you through a hypothetical example. Now, again, for those people that are watching this on YouTube, you will see my screen. I'm going to walk you through this. For those people listening, don't worry, I'll describe it. It'll be just fine. So what I created here is a very simple portfolio, and this is exactly the kind of exercise that we do with our clients. I would encourage any of you to take us up on this and walk through an exercise. Let us walk you through an exercise like this. It's an eye-opener. It'll make you a different investor. I would argue a much better investor if you've done this once or twice with us. What I created here is just a very simple portfolio. I took a hypothetical portfolio number of $100,000. You could add a few zeros to that or subtract 1 0. It doesn't matter. The point is it's a simple round number. And what I did here is I took a very simple 60-ish, 40-ish portfolio allocation. In this case, I literally just dumped this all into one ETF, the Schwab Portfolio Core ETF. It's a 64% allocation to stocks. So almost 60, right? They have a bit of a tweak to it to differentiate themselves, and 36% to fixed income. So this is also known, again, as a 60-40 portfolio. It's classic. It's more or less time tested if you're willing to stomach some normal volatility. And this is now the punchline. Now let's get to normal volatility. What does that mean? Because again, a lot of people have forgotten what this means. So a portfolio like this, a 60-40 portfolio, has a 6-month 95% probability within 96 months and 95% probability to have a range of being up as much as 17% and down as much as almost call it 12%. Okay, so let me repeat that. A regular normal 60-40 portfolio, this is a diversified portfolio of basically US stocks and international stocks, and then you have fixed income. Fixed income tends to be focused on the US aggregate bond index. Maybe there's some international stuff in there, but for the most part, that's the typical allocation. For me, I have no problem with that kind of an allocation for the vast majority of my money. There's some tweaks to be made for sure as you go through the economic cycle, but overall, this is not a bad allocation model in principle if some tweaks are made along the way. And that second part there is important. There are tweaks to be made along the way. And that's part, of course, what an investment advisor should do. So if a regular, normal, standard volatility profile for a 64-60-40 portfolio, 60% equities, 40% bonds, has a 95% probability of trading between down 12% and up 17%, then that is something that as a regular investor, one needs to understand and be comfortable with. So some people, when they look at this, when we run through these exercises, in fact, most people are like, yeah, I'm fine with being down 10, 12%, not a problem. Where it becomes more difficult for people is to understand what is that percentage number actually mean in dollars. Of course, simple math here on $100,000 portfolio, an 11, 12% drawdown is somewhere between $11,000 and $12,000 down. So if an investor, let's take investor Mike tells me he's comfortable and doing all the metrics and analysis we do for him, that he's comfortable if his portfolio is anywhere down as much as 12% within 6 months. If that's what he's telling me, and we've do this math, he should not be freaking out if his portfolio is down 12% due to normal market fluctuations. This is not the market crashing. This is just regular, acceptable volatility. However, there is usually a pain threshold where people start to really freak out. That threshold, in my experience, for most people, is somewhere between about down 15 to down 20-ish%. So down 15 to down 20% is usually where people start to get more nervous. And here's what's concerning about that. What's concerning about that is not so much that that's a lot of money. That's not a non-normal drawdown. 15 to 20% for a portfolio is not bad. That's within standard deviations, a drawdown, right? That does not mean the portfolio is done and over with. I'm not saying it's good, but it is, if one has any time horizon more than a few weeks or a few months, that is acceptable volatility. If you can't accept that volatility, then maybe our hypothetical client Mike here shouldn't be in the markets, or he shouldn't have much allocation to equities, right? He should be mostly in much lower volatility assets. And this is important to understand. Now, our risk appetite over time changes. Usually when people retire, and I know there's probably a lot of people here listening that are somewhere within 10 years of retirement, and if you're nowhere near that, this applies to you as well. You will get typically less risk tolerant. You will have less risk tolerance, so less willing to take risk the older we get. The simple example is if we retire, Mike retires, let's say, and he no longer has his income. Let's say he was an employee. All of a sudden, he needs to somehow he has to somehow make as much money, or maybe a little bit less, from his portfolio than he did before with the salary he had, and maybe much less, but again, he has to make some positive return, and it's making him nervous because he no longer has that salary, assuming, of course, he saved money over time, otherwise he wouldn't be retiring in the first place. Now, where this becomes really valuable, and again, I would encourage any of you that have at any portfolio at all, do an exercise like this. Go to your financial advisor, come to us. Obviously, I'd prefer that. Come to us. We will walk you through this. What you have to do is go to bluemarlinadvisor.com. So at www.bluemarlinadvisor.com. You can click a button there. You can do this risk questionnaire, and then we're going to walk you through this. It's important that you then follow up with us. So we're going to follow up with you. This doesn't cost you a dime, but we're going to do this for free for you to walk you through and see how much risk are you comfortable with. Let me get to the punchline. Why is this important, and why do I think you should do this today or tomorrow? Here's why. It is extremely likely that if you don't know how much risk you're comfortable with, or let's say our example, Mike, if Mike doesn't know that he's not comfortable with his portfolio dropping 15% during normal volatility, he is going to panic at the absolute worst time. And we've seen this, and we unfortunately see this all the time. People panic due to regular market volatility. They can't stomach it because things have changed. They thought that 10, 15, 20% was okay for them. But once they see the number, once it's happening, they panic, right? So on one hand, they need to know that number, but they also need to know the actual dollar amount. So it's not just important to think of a percentage term. They need to see the dollar amount. So again, I come back to our example here, a hypothetical example. Again, if you're on YouTube and you're watching this, you can see it. If you're not, I'm describing it here, I think just as fine. If Mike is comfortable with his portfolio dropping 10, 11%, he needs to know that equals $10,000 if his portfolio is $100,000. If Mike is, however, comfortable with a 15% drop, but not a $15,000 drop, right? Just because somehow he doesn't put those numbers into context, and that's a very normal thing to happen. The likelihood that he panics when the portfolio is down 15,000, maybe as much as 20,000. So again, 15 to 20,000 to 20% is very normal. He is going to panic at the absolute worst moment for the most part. So know your risk number, folks. I know for those people that are purely trading oriented, you may say, Serge, I don't need this. This is long-term retirement stuff. It's really not. If you are a trader, this is just as important for you. In fact, most of our clients, whether it's over on the Steady Trader, where it's our publishing and research business, or at Blue Marlin Advisors, where we actually manage their money and give them tailored trading and investing advice by phone and email, most of our clients are both. They are investors with the majority of their money. They have 401ks, they have IRAs, they have their equivalent in Canada and Europe and other places in the world. But they're also, to some extent at least, traders, self-directed investors with some of their money. The risk exercise here is as important for Mike's trading portfolio. If Mike doesn't know that he's going to absolutely panic and do crazy things if his portfolio is down 20%, his trading portfolio, then he's going to probably lose 30 or 40, right? Because what happens if he's down 20%, he's going to panic. He's going to start maybe revenge trading, and he's going to stop being rational. So this is an exercise I would encourage everyone to do. Go to the Steady Trader. Actually, no, you go to bluemarlinadvisor.com. So www.bluemarlinadvisor.com. I'm going to quickly try to show you this website here as well. You go to bluemarlinadvisor.com. And then once you're there, all you have to do is click on a little button that says a risk number. So let me quickly go there. And again, if you're just listening to this, you will just bluemarlinadvisor.com. Let me share that screen with everyone and then talk to it here. So let me go back and share this. Okay. So here we go. Again, if you're on YouTube, you can see this. So when you go to bluemarlinadvisor.com, it says right there, take our 3-minute quiz. Take that quiz, click on it. All you have to do is click on that free portfolio risk analysis. When you click that, there's a couple of pieces of information you put in. It shouldn't take you more than 3-4 minutes, and you'll have exactly what your risk number is. Then, and this is really important, what then happens is you're going to receive an email from myself or one of our partners or investment advisors on board, and they're going to walk you through this. That is the most important bit, because you need to understand what your risk number is. Once you know what your risk number is, it's going to help you not only in your investing to build your wealth for you and your family, but also for your trading account, right? That's really important. So I hope today's episode was helpful to you in terms of showing you a little bit more about what is possible, or what is the importance of understanding risk in your portfolio, how we react to risk, and how we react to risk if we don't know what our risk tolerance actually is. Also, risk tolerance changes over the course of time. So keep that in mind as well. That's important. We're not as risk averse when we're 70 as we are maybe at 60 or 50 or 40 or 30. So hope that helps, folks. We'll see you again in the next Steady Wealth podcast. Until then, be well. And again, go ahead and take that free risk assessment, and we'll talk to you and make sure you understand exactly what it means for you. Until then, be well, trading well, and stay safe.